Whenever oil prices move up, typically we worry about India's current account deficit because we are importing oil and the inflation impact. But there are many times that markets and oil, so Nifty and Sensex and oil prices, they actually move together. Now that doesn't mean that just because there is correlation, doesn't mean that there is a causation or a benefit that the market is getting from that.
Nimesh, I've heard you mention a lot of times that understanding cycles is important. So what does that exactly mean?
So what we learn from history is that we don't learn from history. Let's take an example of the wars in Russia in 3 different centuries. In about 1708, during the Great Northern War, the Swedish army attacked Russia. Russians at that time followed a strategy called the scorched earth strategy, where they destroy everything in the path of the enemy so that those resources are not useful to the enemy, and they try to bring the enemy in and then defeat them at the place that they want to battle with them. So the Swedish army was moving inside. It was winter and it was snowing very badly in Russia at that time. So slowly the Swedish army came in and got cut off from their base. And they had no resources in between to use. So people were falling sick, animals were falling sick, horses and all. By the time they met with the Russian army in the Battle of Poltava, Swedish army had grown quite weak. And the Russians defeated them easily. A century later, 1812, French army attacked Russia. And Russians followed the same strategy. Napoleon with his army kept going inside. Winter set in, they got trapped in the snow. No resources, people falling sick. And Russia won. This was a battle in Moscow. In 1941, again in the next century, during the Second World War, Hitler attacks Russia and they go in with a lot of troops and tanks. Russians follow the same strategy. The German armies got stuck. They lose about, I think, 7 lakh people in that battle. And ultimately, Russia prevails and Hitler loses. So what we learn from history is that people keep making the same mistakes again, and people who don't learn from history are condemned to repeat it. The same happens in financial markets. Now I'll give you 3 examples of books written in different centuries talking how these same cycles repeat in the financial markets also. The most famous book, Extraordinary Popular Delusions by Charles Mackay. This was published in 1841. And Charles is talking about the crisis during his times and before them. And the conclusion is that human beings have their whims and fantasies. They get attracted by a certain delusion and they chase it and they take it to a very high price. And then ultimately something else attracts them and they throw this down. So there is a crash in those prices and they move on to another folly. A century later, Jesse Livermore says that Wall Street never changes. Stocks change, investors change, but Wall Street never changes because human nature never changes. Come to this century where after the 2008 crisis, in 2009, Kenneth Rogoff and Reinhardt wrote a beautiful book analyzing the crisis. This time it's different. And the conclusion of that book is the same, that countries, institutions, investors may change, but human nature remains the same, and that causes the boom and bust cycles in the market. So very important that somebody who's learning about markets, you learn market concepts, you learn about psychology, but you also learn about financial history so that you don't repeat those mistakes.
Can you elaborate a little bit more on the human behavior aspect of it?
So market cycles are essentially human behavior cycles. Yes, economic cycle, the profit cycle do play a role in determining the market's course. But human behavior does 2 things. It exaggerates this move in either direction. So what we call as overreaction. And second thing it does is the exaggeration these are caused by human behavior have an impact on the future of these businesses also. So what we call as reflexivity, that rising stock prices attract more investors and then they also help the company raise money at a better price and so on. So they do affect the course of the businesses also. So it is important for the investors to understand this human behavior behind it. We say that the seeds of prosperity or wealth are sowed at the time of crisis. So when people have overreacted on the down, when they're fearful, you buy them And that's where you sow the seeds of your wealth, because when people are euphoric, the prices will be very high and you can harvest those gains.
Mark Twain said this very interesting thing. He said that history doesn't repeat itself, but it does rhyme. So, do we see these kind of repetitions play out in cycles also?
Absolutely right. Not all events or cycles go exactly the same way in terms of mathematically up and down, but they are similar in them. And investors need to understand both these things. So one, you have to understand history. Otherwise, you'll be prone to mistakes under the term called "this time is different." If you expect the cycles to repeat exactly the same, that means you make another folly, which is everything is always the same. And it never happens exactly the same way. So it is important to understand that these cycles will be there, but they may not be with the same accuracy as, say, the previous part of that cycle. Investors many times learn the hard way that markets can remain irrational longer than they can remain solvent, as it is said. Now, this is because they expect that something which is overpriced will fall immediately, or something which is underpriced will move immediately. So cycles do create opportunities, but it's not that they will be exactly the same.
Okay. So, then how does one get better at understanding these cycles?
So Daniel Kahneman talks about a concept called anchoring
Okay.
and adjustment.
Okay.
What you do is you anchor at the base rate, or what is the basic trend of that cycle, and then adjust to if there are any changes compared to the previous part of that cycle. Now, let me give you an example, more statistical example, how we incorporate new information. Suppose in a city, there are 85% green cabs and 15% blue cabs. And there has been a hit and run case. In the courts, then when this is tried, if there is no witness here, people will say that, okay, there is a 15% chance that it was a blue cab, because 85% are green, 15% are blue. So there's a 15% chance it's a blue cab. But suppose a witness comes and says that, yeah, the person saw it was a blue cab, and that witness is right 80% of the time. 20% of the time, even the witness makes a mistake. So now you adjust the probability of blue cab upward, mathematically through Bayesian formula. It comes to about 41%, right? So now you anchored on the base trend, and then you adjust it based on new information that comes in. Think about the same way in valuations when we look at, say, Nifty. Typically, say, people go for an average Nifty valuation of 17 times. Now, that's a good trend to keep, and maybe the range is, say, 14 to 20. You anchored that average is 17. But this time, compared to the previous cycles, say there are more consumer-facing companies with better cash flows, more sustainable and visible growth. These companies typically get more valuation than the cyclical, maybe sometimes double of the valuation that the cyclicals get. Now, as the percentage is increasing in the index, you shift that band upward. You shift that average upward. So that's how anchoring and adjusting helps you understand the cycle and also the nuances or the new information that has changed in that.
Got it. So, borrowing from that, I assume that a lot of it is based on judgment, how you read and how you understand. So, then as a follow-up question, how does one get more accurate with their judgments about
Very
these
interesting.
factors?
So, when you're looking at data and to understand cycles, first take a longer term cycle.
Okay.
Because many events, they happen, say, once in a decade or once in 2 decades, and those need to be incorporated into your judgment of a cycle. So let's say today we are worried about high debt to GDP of many countries. Now, investors, many of them, have not seen any country default on the payment for many years now. So they may ignore the probability of that happening. But it has happened many times in the past. So you actually increase the timeline, and then you see the history is populated with such defaults, and you have to take that into account when taking a judgment. Second part will be you have to beware a little of averages. So you have to, when you're calculating averages, you should also see what they're hiding versus what they're revealing. Nassim Taleb uses the example very well. He says you take 1,000 people, okay, and then you calculate an average height of that person. And then within this crowd, introduce one more person who is the tallest person in the world. The average will not change much, okay? But if you take the 1,000 people and take an average income that they get, and then introduce the richest person in the world in that group, the average changes substantially. So many a times when we are looking at valuations or averages, we also see in the index, for example, how narrow is the rally. Is it only few stocks which are expensive are driving the rally, which is what is making the market look expensive? Maybe the broader market is cheap on that. And the third most important thing is, just because two variables are moving together doesn't mean that they are correlated in terms of the cause and effect relationship. So what we say is, don't mistake correlation for causation. So there may not be a cause-effect relationship. Example would be, say, oil prices. Whenever oil prices move up, typically we worry about India's current account deficit because we are importing oil and the inflation impact. But there are many times that markets and oil, so Nifty and Sensex and oil prices, they actually move together. Now that doesn't mean that just because there is correlation, doesn't mean that there is a causation or a benefit that the market is getting from that. So if you keep these important points in mind, analyzing cycles becomes easier and helpful in your decision making.
Got it.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.